Hello everyone, welcome to another video of CPA Exam Lab. Today we are diving into the cash flow statement simulation, focusing on the indirect method. This method is crucial because it reconciles the accrual basis net income to the actual cash generated by operations. We will walk through the logic of why we add back certain items and subtract the others. Understanding this reconciliation is a key to mastering the financial analysis for you. Now, let's start by setting up our scenario. Okay, so our scenario here centers on Apex Manufacturing's year two reporting. So in the question, it says our main objective is to prepare the full statement of cash flows using the indirect method. This means we must first determine the net cash from operating activities, then calculate the investing and financing cash flow. We will be using three main data sources, the comparative balance sheets, the income statement, and some additional transaction details. This data gives us everything we need to track the movement of cash. Now let's look at the numbers that we will be working with. Okay, here are the some key data sources, but before that, we try to make this one as close to as possible to the exam. But in the exam, you initially do multiple choice questions and then you go to simulation, and by that point you are tired, unfortunately. Take the break before the simulation because that break is not counting towards your hours. You have only one break during the FAR exam. That does not count towards your hours. Take it, empty your brain, and on the screen you are going to see different tabs, and each tab, when you look at it, it is going to open as a new screen on your screen. The easiest way we find is that you can adjust those new screens, and while looking at the multiple information, that could help you to verify information, basically. Okay, now let's go back to the question. Okay, the comparative balance sheet here shows us the change in working capital accounts. Okay, so which is the vital for the operating section. So here, let's look at here. So we have an accounts receivable, for example, increased by $12,000 here. The income statement gives us our starting point, which is the net income here, 85,000, plus the non-cash items like depreciation and gain on sale of equipment. We have them here. And finally, the additional information confirms the cash received from the asset sale and cash paid here for dividends. Okay, here we can see them here. Okay, we'll start with net income and begin our adjustments now. The indirect method always starts with net income, which for Apex is $85,000. Oh, so this is our accrual basis anchor. The first adjustment we make is for non-cash expenses like depreciation expense. Depreciation reduced our net income, but it did not receive any actual cash outflow. And since we are trying to find the true cash flow, we must add back that $18,000 of depreciation. And this adjustment brings us closer to the actual cash generated by the business. Next, we'll tackle gains and losses. Okay, now we are in the second step. Here we are adjusting for gains and losses, which are non-operating items. So here these gains and losses are included in net income, but the actual cash transaction belongs in the investing or financing section, not operating section. So therefore, we need to remove them from the operating section to avoid double counting. The rule is simple. If you have a gain, you subtract it. If you have a loss, you add it back. Apex had a $5,000 gain on the sale of equipment, so we subtract that $5,000 from the net income. This ensures that the full cash proceeds from the sale are correctly reported only in the investing section. Now we move on to the working capital changes. Now we move to the final step in calculating operating cash flow, adjusting for changes in working capital. This step accounts for the timing differences between when revenue and expenses are recorded and when cash is actually exchanged. Here you may remember the CLAD mnemonic to remember the logic. Current liabilities are a direct relationship to cash, and current assets are an inverse relationship. For example, an increase in accounts receivable means we made a sale but haven't collected the cash yet, so we deduct it from the net income. And conversely, a decrease in inventory means we sold goods, which is cash inflow, so we add it back. By applying this logic to our changes, it gives us the net positive adjustment of $4,000 here from working capital. And here this completes the three major adjustments needed for the operating section. Here this slide summarizes the entire operating section, reconciling net income to the actual cash generated by business. We started with $85,000 in net income and made several adjustments. The non-cash charges like depreciation, which is added back for $18,000, and the gain on sale reduced cash flow by $5,000. Finally, the net working capital adjustment added $4,000. The result is a net cash provided by operating activities of $102,000. So this $102,000 figure is significantly higher than net income, which is a strong indicator of high quality earnings. It means the company is generating real cash from core operations. Now that we complete the most complex section, now let's move on to do investing activities. The investing section focuses on the long-term assets, primarily property, plant, and equipment, or PPE. To determine the cash flow from the PPE, we often have to reconstruct the account using the T-account approach. We start with the beginning and ending balances and use the non-depreciation to solve for the cash spent on new purchases. In this case, we calculate a plug figure of $63,000 for new equipment purchase, which is cash outflow. We also had a sale of an old equipment. We use the actual cash proceeds of $20,000, not the book value, as a cash inflow. The net result of these two transactions will be used in the final statement. Next, we'll analyze how the company's finance these how this company finance these operations. Okay, so the financing section tracks transactions with creditors and the owners, specifically long-term debt and equity. We analyze the change in the long-term debt account, which decreased by $20,000. Yes, so this indicates a cash outflow for debt repayment. The common stock or account increased by $20,000. That signals a cash inflow from issuing a new stock. We sold stock and we got $20,000. And finally, we must account for dividends paid, which is a direct cash outflow to the owners. The company paid $25,000 in dividends. So these three items capture all the cash movements related to financing the business. Now we have all the pieces together. Now let's assemble the final statement of cash flow. Okay, so this is the final statement of cash flows, bringing together the three sections we just analyzed. We start with the strong $102,000 from operations. $102,000 from operations. Investing activities resulted in a net cash outflow of $43,000. This was primarily due to significant capital expenditures. And financing activities also use cash with a net outflow of $37,000 driven by a debt repayment and dividend payments. Combining these sections give us a net increase in cash of 22,000 here for the year. When we add this increase to the beginning cash balance, we arrive at the ending cash balance of 55,000. Okay, so this figure must match the cash balance on the year-end balance sheet. So that would confirm the accuracy of our entire statement. Okay, so we just completed the full statement of cash flows. It can get complicated. It's not, it's logical. No one understands it in the first time, so do not worry about it. Watch it over and over again until you understand. There are several simulation types, but once you understand in the exam day, it will be much easier for you. Just practice and practice. Okay, so now let's distill the key strategic takeaways for the mastering the indirect method. So the entire process anchors on net income. So we start from the net income, then systematically convert that accrual number into a cash number. So the first step is reversing the non-cash items like depreciation and amortization. You add these back because they reduce net income but didn't actually use any cash. Next, you handle non-operating gains and losses. Subtract gain and losses to remove their effect, isolating the core operating activity. And finally, remember the CLAD mnemonic for working capital. Current assets are inverse, current liabilities are direct. Okay, so I just repeat it here. You just memorize this. It's going to help you in the exam day. Just write on the scrap papers they give to you. Current assets are inverse, current liabilities are direct. The logic is crucial for getting the sign right every time. But remember, for investing and financing activities, you must analyze the activity, not just the net change. So for this one, accounts to find the hidden inflows and outflows. Okay, so mission accomplished. We reached the end of this intensive series on the FAR statement of cash flows. So hope this was helpful to you. Don't forget to like and subscribe, and thank you for watching.